All right, this is the second part of a look at our ITRs and ROAs. So in a previous video, we actually calculated what ITR and ROA were for a fictitious company over a 6-month period. So we have the 6 months from January to June, and we're able to calculate an ITR of 12.72, or our turns. And for that same time period, we had an ROA of 6.56%. So you see that in the previous video. In this video, we want to give you a scenario where things change. And it's important to understand what impacts what when those types of things happen. So in this scenario, what we're saying is that you have a 25% reduction in inventory. So all other things are remaining the same, right? Rather, I should indicate the reduction over in inventory. So we're going to reduce our inventory by 25%. So in this assumption, it means that you're still going to have the same in sales revenue, you're still going to sell the same, and you're still going to have the same net profit. All that you're doing is you're able to do it with a little bit less inventory. So something that we need to understand is where that impacts our financial statements and how that makes changes to both our turn ratio and our overall ROA. Okay, so let's just look at the two scenarios, and I've done a little bit of quick math to save us some time here. But essentially, let's start on the top, and we'll look at inventory. And what you'll see is that, for example, in the month of January, we started out with $278,000 in inventory. Well, we've revised that here so that now our inventory amounts are minus 25%. Okay? So we know something, though. We know that the inventory lives on the balance sheet. And in particular, it lives in the area of our assets. So it's a component of our assets. Okay, so if we're able to take our inventory down, then that means that we're actually going to take our total assets down at the same time. And it's pretty easy to do this. All we're going to do is take the change in inventory and reduce our total assets by that change in inventory. So for instance, let me switch to green. So up here in January of the first month, we had 278,000. So we had 278,000 in inventory in scenario number 1. And then in scenario number 2, we have 208,000. I'm rounding out numbers here, but there is approximately a 70K reduction. So what ends up happening is we take our total assets down by that amount. So it moves from 5.1 million. Down here you'll see that it declines about $30,000 or $70,000 to 5,030,000. So we've had some positive impact in taking down our inventory, right? That's a good thing if you can maintain sales, because it just means you don't have to have as much product in inventory. But with that comes the coincidental reduction in the total assets. So that makes a little bit of a difference on our ratio. So let's recalculate our new ratios here. So let's go back and we'll start with ITR. We'll do ITR in blue. Okay, so we know our formula for ITR, which is cost of goods sold divided by the average inventory. So our cost of goods sold still stays the same, right? Because we're saying that we didn't change anything. So 2,848,000 is our cost of goods sold, right? Our sales at cost of goods sold. And again, as we mentioned in a previous video, we don't need sales revenue for this metric. For any of these ratios, we don't need it, so we get rid of it. And then we're going to divide it by the average inventory. So the average inventory now is decreased a little bit. So now we are 167,875. Okay, so we divide one into the other. Okay, so we get an ITR of, let me just do this very quick. Probably should have done this in advance, but okay, divided by our average inventory. All right, 16.97. So 16.97. Okay, that's our new turn ratio. Now let's do our ROA. So I'm going to flip back to green here. So I'll move over here. So our ROA is profit divided by the average assets, so profit coming from the income statement. So our ROA is equal to, our profit still stays the same, so we are 398,720, because again, we're making the assumption that we sold the same. We just had a positive impact by being able to take down the number of goods we had in inventory. Now we're going to divide those by the average assets. So our average assets has gone down a little bit. We're going to bring that number down here. And now it is $6,017 or $17,640. Okay, so let me go back to my calculator here. And we'll divide one and two together. And we get an ROA of 6.3%. Okay. And that is our ROA. So, two scenarios. In the very first scenario, let me flip back over to red here. I'm going to go up here. Our first turns ratio was 12.72. We've actually had a positive effect on our turns. We've been able to move the number of turns up significantly from 12.72 to 16.97. That's a pretty big change in turns. Now, I mean, overall in our ROA, it doesn't mean that much. Let's use blue for this one. So we were able to take our ROA of 6.56, and we did improve it, so we're getting a little bit more bang for our buck to 6.63. Okay, so that's an example, and it is important that we understand the impact that inventory has on our financial statements and some of our very important ratios, such as ITR and ROA. In the same way that we did this, you could have had the reverse happen. You could have had your inventory go up. You could have had your profit come down. You could have had your carrying cost change, whatever it is. Think through where it affects and what you need to change, what you don't need to change, and then recalculate your ratios based on that. And you should, just knowing what's happened, you should be able to anticipate the change in your metrics. So for instance, as we did here, a decrease in inventory while keeping sales the same is a good thing. So you would expect your turn ratio to go up, and you would expect equally that your ROA would also go up. But conversely, if you had to have much higher inventory levels, it means you've got more money invested in the business, it's costing you more money, and your turns are going to go down. So in the instance, if we said, hey, you had to increase your inventory by 25%, these would have moved in a different way. You would have ended up with a lower turn number, so instead of 12, maybe it would have gone down to 8 or 9. And then your ROA would have gone down, from 6.5 maybe to 6.4 as an example. Okay, hopefully that helps to clarify. But just remember, it is important that we understand the impact to the financial statements and how changes in any of those balance sheet or income statement lines affect the ratios.